market had this terrific run, obviously, from, well, really from 2009 to 2 weeks ago, and it had a particularly strong run from last fall until the present. So I think the market got a little bit extended, and I think maybe too much optimism crept in, which means some of the buying was based on momentum instead of actual investment characteristics. But I think what you've seen now is a correction in some of my favorite companies that have taken them back down to more more buyable levels. I think from a price-earnings ratio, some of these stocks got higher than they have been historically relative to the market, but I think on a yield to treasury basis, I think they are still attractive. And so people are kind of putting down utilities, but I have to tell you that some of these utilities will grow their dividends at 8, 9, 10% a year, things like NextEra and Wisconsin Energy. And so I think, yes, they got expensive on a PE basis, but they're still yielding close to 4%. And I think they should be attractive for people who need a rising stream of income. I think consumer staples, I mean, these are great companies. I love these companies that where the products get replaced, get used up and get replaced. Those are the classic growth stocks. The old Gillette, you know, sell them the razor and then have to replace the blades. And so what we want are these companies that make products that people use up, and that can be from consumer staples fall in there now. Did they get a little bit expensive? Yes, but they're dividend raisers. Procter & Gamble has raised its dividend consecutively for 58 years. Johnson & Johnson, 50 years. Kimberly-Clark, 40 some years. Those are good stories. I mean, it's not like those stocks are like priced like internet stocks were in 1999. They're just a little bit above market multiples. That's not the worst thing in the world. Non-traditional, I'm not sure what I would call non-traditional. I think that I think there are a lot of companies in technology, for example, that never paid dividends, that have now who now understand that paying a dividend creates a whole new category of shareholders for them. So I would cite Intel, which when we bought it was yielding over 4%. Cisco Systems finally got the message. They upped their dividend to where it's over 3%. Texas Instruments just raised its dividend 33%. It yields over 3%. These are good companies. I don't know what their growth profiles are going to look like over the next 5 or 10 years, but they're returning capital to shareholders, this excess capital. It's good. Microsoft, which has stubbed its toe on many different things, but still is enormously profitable, raised its dividend 15% last year. We'll expect another good increase this year. So those are non-traditional, but they will become increasingly important. I think companies have a lot of room to continue to increase their dividends because the after-tax payout ratio of dividends used to be about 50% for corporate America. So prior to the 1990s, companies would earn their money, pay their taxes, and out of that after-tax income, they'd pay out 50% in the form of dividends. Dividends fell out of favor in the 1990s as stock options, corporate CEOs decided to kind of stuff their pockets with stock options, and so dividends fell down to 25% of after-tax profits. They've climbed, despite all the good increases, there's still only about a third of after-tax profit. There's so much room, and companies are flush with cash. So yes, there's a lot of room for dividends to keep growing, and I think I call this the golden age of dividends. You're seeing spectacular dividends. I've never seen anything like this past 5 months. Yesterday alone. This is Thursday, yesterday, Wednesday, the 12th of June. Caterpillar, 15% dividend increase. Target, 19% dividend. Who's getting raises like that in their real world? This is great.